little bit more about my background. I've been with BlueTree for the past 6 years. The first 4 years I was with BlueTree, we were BlueTree Allied Angels. We were an angel fund here in Pittsburgh. The last 2 years, we transitioned into a venture capital fund. I've seen well over 2,000 pitch decks, probably over 100 pitches. I've evaluated, we make about 4 to 6 investments every year into new companies, along with 3 to 4 follow-on investments to our older companies. We have a portfolio of around 46 or 48 companies currently. Our newest fund has 4 new companies to add to that. So we've been around for a while. Catherine, my partner, has been doing this for the last 20 years. She's actually the one who came up with the deck that I'll be pitching right now for you guys. And so with that, we'll talk a little bit more about pitching to investors. And so first and foremost, and before you worry about what's up on the slide, the first thing to think about is remember who you're pitching to. And before you go into any pitch, know as much as you can about that investor, not just investors in general, but is this a type of fund that is looking to return the fund on every investment? Is this a type of fund that's looking for a 10x? Are they looking for unicorns? Are they looking to be more advisors, or are they looking to be more passive? What is it that they want to get out of it? What is it that they expect to get out of it from you? Beyond that, almost all investors kind of rank what they're looking for in this order. First and foremost is the management team. And the reason that that's always first, percentages wise, people move it all around, but that is the most important piece because it is the most costly piece to fix down the line. If the management team is wrong, it more than likely means the company fails. There are times where you change out a CEO or a management team, but it's expensive in terms of capital. It's expensive in terms of time. You lose your ability to stay ahead of the competition. The next most important thing for investors is going to be the size of the opportunity. And this does not mean that you know, almost always we hear it's a 1 billion, 10 billion size market. The idea is not that the company will grow to that, but there's enough room in the market that you can grow for a while without directly running into competitors and having to fight for space. Because as an early stage company, you need time to kind of establish what is your value, what is your value proposition, get all the evidence before you're really ready to get into a big fight with kind of the 800-pound gorillas in your market. Following that, the product or service that you're offering, what is the problem you're solving? How is the solution that you've developed unique compared to what's already out there? That falls into the kind of the technology you're using. What is it that makes you unique? How are you going to outmaneuver your competitors in the space? And lastly, what's the investment structure? Is this a convertible note? Is this preferred equity? What's the valuation? What are the terms of that? How's the board structured? All of that kind of thing. Thinking about the management team from our space, but you're going to hear this from basically every investor, is they're looking for quote unquote coachability. And that means different things to different investors. Some investors are going to want you to listen to them and do what they say. Some investors are going to want you to fight back against them and hear what they say, but also do what you have to do. Some investors are going to want to be on your board. Some investors are going to want to talk to you every day. So that means different things, and you have to know what that means to your investor before you go into the talk, or definitely before you accept their money. And what are they looking for in the rest of the team? For us, we want to see a balanced and complete team. This means that not everyone is a computer scientist out of CMU, and you don't have 4 founders and all have the exact same background, all have the exact same life experience. You want people who see each other's blind spots, first and foremost. 2, you want them to be able to talk to each other. You want them to be able to disagree with each other. We want to see that. We want to see that everyone has a voice and is willing to be heard and is willing to disagree respectfully, because investors are going to be with you for 3, 5, 7, 10 years, and there's really no way to get rid of us. And so we want to know that your team can handle the ups and downs that are coming over the next years. Not everything is going to be roses. There are going to be tough times. You guys are going to disagree. How do you get past all of that? So what are we, oh, please go ahead.
Is that something like, how much pitch?
You can show it in a lot of different ways. In the pitch, it often comes about where different people take on different parts of the presentation. Maybe you have someone who's very good at the financials, kind of leading the discussion on the financials, where another person who's really good at the technology is leading the flow on the technology. How is that transition happening? How, when the Q&A happens, if one person gives one answer and another person disagrees, how do they bring up that disagreement without being disrespectful and showing kind of how do they build off of each other? The idea is not that any one person has all of the answers. The idea is that the team as a whole has better answers than they would individually. So let's talk about what we are looking for when we invest. So for those who haven't been through this process before, from a venture capital, from an angel perspective, what we are doing is we are giving companies money. We do not get dividends. We do not get interest. We get no return until you sell the company or it goes IPO. That's the only way we get our returns. And so we need to see that you can grow the company from where it is now to a point that someone else either wants it or to the point that you're ready to go public and the public can value it at a certain amount. That's when we get our returns. And to give you money and not get anything back for many, many years, sometimes, on the early side, 5, on the later side, it can be 10 or 12 years. We need to see that this is going to grow very significantly. And what I mean by very significantly, you can see in the second bullet, is we're looking for 10x to 30x returns. Why so high? Because most of our investments are going to fail. We know that ahead of time. And so for the ones that do make it, they have to have the potential to make up for all the failures, plus show a significant amount of increase in value for our investors, because behind us is another set of investors who invested in us and a board that's watching every move that we do. So we're also, in some ways seeing the same kind of dynamics that you guys are seeing from your side. And so to do that, we build a portfolio based on what our risks are, what the rewards are, and what we're looking for. And so that goes back to my earlier points. Before you walk into any investor's room to pitch to them, you should have a good understanding. You can ask them ahead of time, what is it they're looking for? Are they looking for an investment that will return the fund? So if they're a $100 million fund and they're investing $2 million in you, are they expecting to get $100 million back out of this? Are they looking for a 10x? Are they looking for an IPO? Are they looking for a unicorn? What is their expectation of what you should be aiming at this point? Because where you're aiming right now is likely the highest you're going to hit. It's only going to go down from there. And we know that that's built into all of our models. But we have to see at least the potential for the types of returns we need in order to even make the investment. So let's so now let's actually talk about the pitch. And you guys can look it up, but there's a relatively famous 10-20-30 rule. 10 slides, 20 minutes, 30-point font. Most of my slides are at that 30-point font. And I don't have any, whoops, wrong way. I don't have any graphics or visuals or anything else. And you can see that there's not a whole lot of information I'm presenting on the slides. The slides do not allow you to present a lot of information. Typically 1 to 3 sentences broken up by a graphic of some sort that presents the idea better. You need to use those words very carefully. We see a ton of people try to put things in 12-point font that are basically unreadable because you're trying to tell the entire story of your company on the slides. The slides are not for that. They are to get the big point across, hoping that your audience can read the slide very quickly and then shift their attention back to you to listen to what you are telling them and ask you questions. 10 slides, 20 minutes really gives you 2 minutes per slide. It's not a lot of time, but there are key slides that you want to have in there. Here are the slides we typically see. After introducing yourself, you want to tell and I'll go through, the rest of these slides are actually going through each of the slides in depth. But you're going to tell what's the problem, what's your solution, what's your business model. Now, as tech people, generally, we tend to see that's the weakest slide. That's the one that needs the most work. What is it that makes you special? What's the underlying technology? What's your magic? how are you going to actually get this out there? So we'll talk about it more on the marketing slide, but a lot of people think the hard part is building a great product. Building a great product is hard. Getting people to actually know that you have a great product is much harder. This isn't what we tend to call field of dreams. This isn't something where you build it and they will come. You have to build it and then you have to tell the world about it, and you have to hope that someone believes you enough that they want to come and actually try your product, use it, and then eventually become long-term customers. Who else is out there in the market and how are they addressing this same problem? What's your management team? And then the last two, what are your projections? What are the milestones? How are you going to hit them and what do you need to hit them? Any questions about the general presentation before we go into some of the details of some of these slides and why they're important to an investor? Please.
So you talk about marketing and sales in the sense of like, okay, you build a product and now you're marketing it. Where's the, regarding marketing and sales, can you also include either in marketing, sales, and business model about market research you did prior to building the product or as you were building it?
Yes, and you should, and it should come up in identifying the problem. It should come up in how you came to your solution. It should come up in the underlying technology and the business model. All are ways in times where you should talk about how you validated that this is an actual problem that people are willing to spend actual money to solve.
Thank you.
Hey.
One online question. How many pitch decks should a company have and how should they differ?
So at the bare minimum, 2 pitch decks. One pitch deck is a send ahead pitch deck. This one, forget the 30-point font rule. This one can have very small font because you're sending it for people to actually read. You're not actually pitching it. So all the information kind of has to be on those slides. Same basic format, but much more detailed. The second should be a pitch deck, which then follows the 30-point slide, much less information, really meant to kind of get the conversation moving. That's the minimum. We tend to have specific pitch decks even for specific investors. If you have an investor who really is focused on a specific type of technology, you might change the pitch deck a little bit more to accentuate why your technological solution falls in their kind of frame. If you have one that's really about go-to-market and about strategy, you might spend a little bit more time on that slide, or maybe make that 2 or 3 slides to build it out for that investor. So you take the basic 2 pitch decks I just talked about, and you can customize them for specific investors, depending on how much you know about them and what you really want to tell them about it. Yeah.
I wonder if it's necessary to include the financial projection part in the slide.
Yes, it tends to come at the later side in the projections and milestones. We want to see your financial projections, and we'll talk about that in a little bit, but that is probably one of my big pet peeves, is think about what your financial projections are really telling your audience. If you're telling, well, one, what I always see, and we've never actually seen in practice, is someone telling us we have no revenue today, we'll have $1 million of revenue next year, we'll have $5 million of revenue in year 2, we'll have $50 million in revenue in year 3, we'll be over $100 million in revenue by year 4. I see those numbers all the time, almost every pitch I see. Not once do I believe them, and never have we seen that actually play out. You want to show very aggressive growth, don't make it unrealistic. Also understand why you are showing those numbers. If you're showing me $50 million in revenue, is it because you think you're going to become a profitable company, you're going to be an ongoing concern, or is it that you're recycling that revenue back into the company to grow it? Why are you showing that much revenue, that much growth? What are you going to do with that money? And think of it from my perspective. If you were suddenly building a company that's throwing off $50 or $100 million of revenue, how likely, one, is it that you're going to want to sell it and give up your nice position as CEO of that company? And how many companies can actually buy a company that's throwing off that much revenue? And have you just structured yourself for a pathway that doesn't make sense for me as an investor to get my money back out of it? Have you just told me you're not planning on selling the company? So financial projections are very important, but also understand the story that they tell is as important as the actual projections.
So how do we make realistic projections if we don't have traction? Let's say we're a seed round, very early stage company.
You make the projections as you would, but temper them with reality. Temper them with the fact that I might think that I'm going to grow 10x every year, but that's not realistically what happens. You know, maybe we launch a new product in this year and we see a little bit of growth. Maybe organically we grow this year. Maybe we raise another round of investment this year. Maybe things don't happen that way. And so the growth is more on the 50 to 100% rather than the 5 to 700%. Just build them out and have justifications for it, but also build out conservative models about how you're going to survive if your revenue doesn't match your projections.
What we did is we took our top 4 competitors and then just took the average for their download, use that as our projection. My question was the timeline. Then does it make sense to put like some blurb or something that talks about potential exit events, like if you're interested in IPOing or if you're interested?
Yes,
It does. You would like to see that.
I want. So, do I think that you're going to be correct? No, I absolutely think you're wrong. As with the financial projections and as with anything that we put together. But I want to see your thought process. So my fund tends to like to see multiple types of exits. Okay, we're going to get to here and we're going to have optionality. We can either exit at this price or we can raise a round and keep growing to this other thing. Here is the milestone we need to hit. Let's I don't know. Let's take a food company, for example. We need to get into 10 stores. We need to land Whole Foods and we'll be ready to an exit. Or we could take some more money and build out a second or third product line and get into these other stores and do a further exit down the road. Maybe our first exit would be to a supplier of this type of product. Maybe our second exit would be to more of a national, like a, I don't know, an Impossible Meats suddenly would be interested in our product. What is it that you have to hit? Who is it that's interested in acquiring you if you do get that? I'm more interested in that thought process, and that gives me an idea of, okay, if you're raising this money, how do you get to that milestone? And is it enough money to get you to that milestone? And if you come back to me for more money in the future, what's the next milestone I expect you to be aiming at?
Thank you. That's helpful.
So let's talk about the first slide. The first slide is the introduction slide. It talks about who you are. It gives you, the name of the company, all of that. Key points. Be concise as to what you're doing. In under 10 words, describe exactly what your company is doing. And really think big picture here. You are not a technology company typically. You're a company that's solving a problem and you're attacking it in a very specific way. And that's what you are. Yes, you're using technology to do that, but you are not truly a technology company. Why is that important? Because down the road, your technology will become obsolete. If you're only a technology company, you've limited yourself as to what can happen down the road. If you're a solutions company, then as the technology progresses, so does your solution. Always helpful to know upfront how much money you think you need. Now, that number is going to change over time. As you talk to more investors, we often find, I like to know what the company is asking us for, but we will tend to negotiate that number up or down depending on what we think realistically the company needs to get to the milestones that were mentioned earlier. And then this is not hide the rabbit. You want to just cut to the chase, be as direct as possible on every one of these slides. Next is the problem slide, and unfortunately we can't see it up there, but that doesn't matter. The problem slide is probably the biggest slide. It is the slide that either hooks your audience or not. And the first 3 slides, title slide, problem slide, solution slide, you have to cover it in probably 3 minutes, preferably 90 seconds. You have to hook your audience, because if they're not hooked here, especially in the Zoom world, they're off onto other windows reading other stuff while you're pitching. I can tell you, I've done that a number of times, and so has every investor I've ever talked to. If you haven't caught them in this slide and the next slide, that's end game for them. So what is it about the problem side? You have to describe the pain. What is the pain that you're trying to solve? Who is feeling the pain? who is paying for the pain? This goes to your earlier question about market research. This is the time you actually say, look, we've talked to real people, get out of these walls and go talk to your audience and ask them, are they dealing with this pain? How have they solved it to date? And would they be willing to pay for a better solution? Sometimes what you think is the problem isn't a problem. Yes, they're dealing with it and they don't care. That's not the real problem that they're facing day in and day out. And so you don't want to be a solution that's in search of a problem, because that's where we see most of our failures come from. And all investors have that same problem, where we fell in love with the technology, invested in it, and then realized, whoops, we love the technology, but that wasn't a real problem that anyone wanted to pay for. So eventually all of us learn this lesson and we keep making it, but that's just because we're human. But this is the biggest, this is where you really start your story. And this pain should come up in multiple other slides throughout the presentation. How do you solve it? How do you go to market to solve it? How is your technology the best way to solve this problem? How are your financials going to be driven by solving this problem for people? So this sets your hook. The solution slide is the one where we come in and kind of fix that hook. Here is how you're going to alleviate the problem. And here is not a technological solution. Your solution is not that we're using AI to solve this problem. Your solution is philosophical. These people are facing this problem. We're attacking it from a different direction than everyone else has to date. And because we're attacking it from a different direction, we're in a blue ocean. No one else is addressing this problem in our way. There is a set of customers that are unprofitable for everyone else that we can address, and we can expand from that set of customers onto everyone else. That gives you the kind of, how are we going to solve it uniquely, and how are we addressing this problem unique? This is not the place to get deep into the technology, because the solution, the technology isn't dependent on the solution isn't dependent on the technology. It is one way of solving this problem. Next is the value proposition. And this is, next is the go-to-market strategy. And the key here is, as an investor, I need to know how you're going to make money. So, okay, you've told me that there's a pain in the market. You told me you have a way of solving it that no one else has. How do you make money here? Who is going to pay for it? Are they the ones facing the pain? And if so, how much are they willing to pay for solving this pain? Even better, how much are they paying right now to solve this pain? What's the status quo? Here is where, if you've done market research, here's where you start to drop the names of the organizations you've talked to that are dealing with this and that don't have a solution and that liked what you were proposing. This is where you can kind of hook. If you've gotten the investor to believe in the problem and believe in your solution, this is where you hook them that you're real, that this is a real solution that can be implemented and has legs to grow. One thing about problem solution go-to-market strategy, try not to be revolutionary in these three areas. Revolutionary causes two problems. Revolutionary causes the problem of, if it's truly revolutionary, you have to educate your buying public about what you are. Education is extremely expensive in terms of marketing, in terms of sales, in terms of belief. It is very, very difficult. It can happen in lots of companies, not lots. Some companies have done it, but it is hard. It costs a lot of money. Second is, if it's truly a revolutionary solution, what you are saying is that you have found something that no one else who has looked at this problem has ever seen. That is somewhat of a hard proposition for investors to believe. Finding a new way of solving a problem, that's understandable. Finding a whole problem that the rest of the world has never seen before, that's a little bit harder to believe. And then saying that you're going to be able to, that this problem has existed and no one's feeling pain from it, or they're feeling pain from it and they don't realize, it's hard. Not impossible, but it's hard. So if it is truly revolutionary, try to use an analogy back to something that's more familiar, that we can get our hands around, that we can understand where you're coming from and where you're going. How do you get there? So now let's talk, oh, please.
Like, when you invest in something to bring some of those distribution channels, et cetera, so like, doesn't a lot of your angel investors or like potential VCs help open up some of those distribution channels? It's like a chicken and the egg kind of like,
They-
I want to do this, but I don't have the connections yet, is that?
They can, and they will for you. But if you are telling an investor that I have a great product, that I don't have anyone who's going to buy it from me, that's problematic. Now, having a great product, having clients, and then bringing you more clients, they will do to their best ability because it's in everyone's best interest. But do not depend on your investors to bring you clients. Your job is to bring it to market. They can help you, they will support you, all of that. But if you're telling them that you need them to bring it to market, you've told them you have a solution without a problem.
I'm just thinking like for us, we digital therapeutics stuff, like it can go through payers, it can go through pharmaceuticals, it can go direct to consumer. There's a lot of ways it could go, and like try to avoid D2C because that's like throwing money into the void basically. But other than that, it's like it will depend on if people have relationships concerns with the provider. They have relationships with benefits, and so I just like I can put them all on the board, but then it kind of feels unfocused, and that's the right word.
So identify what is the problem that you're really solving, and what is the commonality between all of these that says that they all are facing the same problem? Because obviously they are facing the same problem. They may be in different industries, that's true, but the problem is not unique to every one of them. And so that's how you kind of create the thread around them. And that's how you say, here's who we solved it for to date. And if you can introduce us to more, we'd love that. But we are going to continue working on leveraging these clients to build our client base up even further.
The online question.
Oh, yeah.
What percentage does scalability play the part in sense of vision to investors?
We need to see that this is a scalable problem. By that, from the opening, the size of the market, is the market large enough? Now, be careful how you describe your market. Many medtech companies will describe their market as the size of the cost of healthcare in the US. That is not accurate. Yes, it's a very large number, it's trillions of dollars, but it is not an accurate representation of what your market is. That being said, don't limit your market to just your solution. The total addressable market is how much money is being spent on the problem that you've addressed. If I'm going to go with augmented therapy. If your market is augmented therapy is one of our companies, it's augmented reality physical therapy. If your market is augmented reality physical therapy, it's not just people who are using technology to do physical therapy. It can be the entirety of the physical therapy market, which is a good start. It can be even further beyond that. You can see physical therapy in an augmented reality world being used to help with depression, being used to help with getting other patients up and moving to increase their, or I guess I should say decrease their time in the hospital by letting them heal faster. So there are other ways to size out the market, but it is focused on the amount of money being spent on rehabilitation, not on curing, not on surgery, not on diagnostics, not the rest of healthcare, this idea of rehabilitation after some sort of incident. And so that's kind of their size of market beyond just physical therapy. So it can still be large, but make sure it's connected to your actual solution, not just trying to build a big number. Okay, so now let's talk about the secret sauce. This is important, even though I said earlier, this is not where you should start with your solution. Once you've gotten them to buy into the problem and the solution, how is it that you are going to solve this specifically, and why is no one else going to copy you? If you're successful, how is it that you're going to stop other people from doing it? and this is something we're going to talk about tomorrow, actually, and I'm coming back tomorrow to talk about IP strategy, but this is one that's important because think about what you do with different types of things. So it might be a trade secret. It might be that you guys have some secret sauce that no one else can. That's great. It might be in trademark. That's typically called first mover advantage. We were out there first. We've got the brand. We've developed the brand. We spent on the brand. It might be in your actual technology, and then you have to be a little careful. Anything you put into a patent, patents are great. They are, I mean, I'm an IP attorney, but anything you put into a patent is out for the public to see, which means anyone can copy it. Now, the other belief about patents is that you can stop people from copying it. That is true. Only if you're willing to spend 3 to 5 years and about $3.5 million to do it. So as much as patents can protect you, they are not going to fully protect you, and they're going to cost you time and money. So think about how else do you keep your secret sauce secret so that no one else can copy you and take what you've developed. If you prove out that this is the right solution, how do you make sure that you're the only one that can bring that solution, or you're the one that can do it best? This is a slide where diagrams, pictures work the best because technology is relatively hard to understand. If you think about your audience, they are extremely intelligent investors. They are not extremely intelligent technologists typically, and they are definitely not experts in your technology. So this is the place where dumbing it down a little bit, not because they're unintelligent, but because they're not experts in your field, makes the most sense. Think about this as explaining it to your parents or your grandparents or someone who's not in your field. You know, someone who you respect, but understand that you can't just talk about I don't know, chat GTP or things like that, and for them to automatically know what that means. Use diagrams, use analogies, use other ways to kind of tell your story here. So now you were asking about market and market sizing. Here's where this is a slide that really comes across. And again, remember, 30-point font. You don't have a ton of space to tell detailed stories here. This is a lot you're gonna have to memorize and pitch. You want the big concepts up there. You want, okay, here is how big this market can be. Here's what part of this market we're going after first. And here's why no one else can make money in this market that we're going after. This is also the slide that sets up the structure for here's why we're asking for the money we're asking for. Okay, so this is the market. Here's the market we're going after first. Here's what we have to raise to get to that piece of the market. Here's how we're going to do it. Competitive landscape is always an interesting one. This is most often done by a grid where you have features on one side, competitors on another side, and a grid of who has what, with obviously your company having all of the features and everyone else having pieces of it. And it is useful to structure it that way to help investors understand what is different from you about the competitors. The other point here to make when you're doing that type of system is don't pick random features. The features should all be interrelated in some way, such that the set of features that you put up there not only make you unique, but are also the story about how you're solving that problem. And that structures you as to why you can solve it for the beachhead market that you've selected, and the other competitors cannot, because they are missing one or more of these features that allows them to be efficient in addressing that market. And so it's not just about having features that your competitors don't have, it's having a story about why those features are important for the beachhead market you've selected. Okay, so now talking about the team. We've talked about the CEO, the founders, we've talked about the management team. Now is when you get a little bit more into the rest of the team, the board of advisors, who are your investors? Who are you looking to have join your team down the road? What are you looking for from your investor? This is one of the key places where you can say, look, we are looking for a board member and we've noticed X, Y, and Z is on your team. And we think that person would be an ideal fit to fill this hole in our team. We'd like to see them on our board, or we'd like to see them as part of our advisory board, or we'd like to have them mentor us. This is where you kind of make your ask from the founders, or sorry, from the investors. And this is where you show them that you are coming to them for more than just money. You don't see them as a bank. You're not just pitching to 1,000 different investors. You selected them because of a specific reason, and here's why. This is also where you describe why you're the right founder. Not only do you have the right skill set, but how did this problem come onto your radar? Why are you the right person to solve this problem? Why are you motivated to solve it? What is it that connects you to this problem? You were asking about forecasts and financials and how they should be structured. Yes, provide a 5-year forecast, and yes, it should show that you're increasing in revenue and that you're using that revenue well. It also is helpful to kind of say within those different years, what is it that you hope to accomplish? Maybe 2 years down the line, you're going to release a new technology. 4 years down the line, you're going to release a new product. What is it that's going to start moving those numbers up? What are the milestones you need to hit? The projections on the screen should just be projections, but all of those projections should be based on a fully developed model that you should have in your data room. And the projections on the screen need to match the model in your data room. Almost half the time, that is not the case. And you can understand why, because one or the other is changing over time and people are not keeping them up to date. It's understandable, but it's in some ways not acceptable. If you're coming to an investor and pitching to them, everything needs to be up to date. And so if there is a change, so maybe everything matches today and then they don't look at it for a month and something happened in the month, explain it to them, that's fine. But explain to them why and make sure it's realistic. Don't have mismatches that are fundamental to talking about how well you're going to plan for the future with your investors' money. The last point is much more important now than it was 12 months ago, which is be on track to get to cash flow break even. Typically, once you start selling your product, within 6 to 12 months of when you start getting sales. In the past, and I'll just say this, in the past, it was allowed that you could grow without ever getting to cash flow break even. You would just continuously raise money, continuously use the money to build a user base and continually to grow that. Now, investors are much more interested in seeing how you get to cash flow break even. Not that you actually have to be cash flow break even, but if you don't raise the next round, does your company fail? Or are you able to reduce your expenses in a way to keep the company growing at a slower pace until you can raise more capital? All investors right now are very cognizant that the next 12 to 24 months are going to be very difficult for raising additional funds. So they're going to want you to be able to weather out this storm, however long it lasts, and then come to the market with a stronger product when the financial markets are a little bit more open to investing again. And so they want to see that you have that ability to extend the lifetime if their predictions and your predictions about what happens in the general market are incorrect. And finally, exit strategy. We talked about this a little bit earlier in financial projections and should you have exits out there? Yes. Key ideas here are who's going to buy you, how much are they willing to pay, why are they willing to pay that, and have they done acquisitions of that size in the past? Typically, when I say who's going to buy you, I do not mean a specific company. I mean a type of company. Is it going to be a pharma company? Is it going to be a med tech company? Is it going to be a technology company? Who are specific players in that market? What type of acquisitions happen in that market? And what is it that you're bringing to the table for them? Why are they going to buy you? Are you bringing a technology that makes their other products sell to more people? Are you bringing a technology that allows them to increase their average contract size so that they can take all of their current revenue and exponentially grow it? Are you bringing a product that they're going to just sell? As in, this is going to be based on a revenue multiple. What is it that makes them want to buy you? And then it may be too early, but if you have had any conversations with any potential acquirers to validate that those are what they're looking for, that always helps in this point. And then finally, closing. So this is kind of the next slides are going to be basically summary. So close with an ask. We are asking for this amount of money to do this, and we'd like you to invest this amount, and we'd like to get access to this person in your network. Ask, close with what you want to have happen next. We'd like to reach out to you next week to talk about follow-up of whether you want to move forward or not. And if you do want to move forward, what are the next steps for us? Before I get to this slide, I'm going to ask for any questions at this point. Kind of threw a lot, but those are basically the 10, 20, 30 rule in kind of wider format. Yeah.
Do you have to have exit strategy? Like if you plan to continue business?
You don't have to have exit strategies, but if you are thinking that route, venture is not the way where you want to be. Because venture is going to be looking for that. On the other hand, revenue financiers are going to just want to see that you're continuously growing revenue and they're getting their money back through the proceeds on the revenue. And so they don't care, but in fact, they probably don't want to see an exit at all. So again, it depends on the type of investor you're pitching to. The last is common mistakes and some advice we have for you. The biggest thing, especially for tech founders, is founders that are so enamored by the technology that they've developed that that's all they talk about. The entirety of the pitch is how great their technology is, without any discussion of the business side of it, who would want to buy it, problem and solution and all of that. The second one is lack of preparation. Once you guys have the pitch up, pitch it. Walk around your house pretending to pitch it. You know, think about questions that people are going to ask you and then pitch it to a few advisors. There are here in the Swartz Center a ton of advisors who would be happy to listen to pitches just to give you practice and feedback on what you've done. Pitch it to other people. Reach out to some people and just ask for help to pitch it. The final thing is presentations that are too long. You don't want to lose your audience. You capture them in the first 3 minutes. You hold them for as long as you can. You want them to get to the question and answer piece as quickly as possible, because that tells you how interested they are, which means hopefully they're asking you questions during the presentation. But if not, you've left enough room at the end to really start to get them asking you questions. You want them engaged in the process. You want them engaged in your solution. If you've got that, then getting to the next step, starting the diligence process, getting an LOI, all of that becomes much easier. If they're cold, more than likely you've lost them, unless that's the type of investor they are, and hopefully you've gone into the room knowing that. But you don't want this to be winding. You want this to have a flow to it, a story to it. You want to end restating what you started at the beginning, but all of this should have kind of a story that they remember and they take away from this. Think about really at the end of this, when they wake up tomorrow, what do you want them to take away from all of this? What's the 1, 2, or 3 thoughts that they should remember? And how many times have you repeated that throughout your presentation to make sure that they remember it? The final pieces are is as you go through your practice and meeting with other people and pitching to yourself, and develop a set of backup slides. Develop okay, people kind of miss this whole idea of our solution. We probably want to do that. Or people seem to be really interested in our founder. Let's put a full bio slide on him. The market is a little bit iffy. Let's do a little bit of a bigger market breakdown slide. Use your practice to kind of help you develop these backup slides. The best pitches that we've ever seen, the ones that we're most likely to invest in, are the ones where when we ask a question, they've anticipated the question and they have a slide ready to go where they can answer our question and have it all spelled out for us. Any other questions?
This is Martina. I have a question about your company, and I'm curious in what kind of companies you are investing, in which stage, how much are you funding the companies, where they need to be incorporated, if you have any requirements when it comes to the citizenship of the founders, and also in which industries are you spending?
Yes, and those are kind of going to be key questions to ask any investor you meet with, especially before you meet with them. So I'll answer it for us, and then I'll kind of walk you through kind of some of the reasoning behind why it's important. So we are Series Seed Plus, what we call Seed Plus or Series A venture fund, which means we're investing in companies that have revenue, always software-based companies, which means either it's a software company or at least the innovation lies in the software behind a hardware play. We write checks between $500,000 and $1.5 million into rounds that are typically $3 million to $12 million. We are looking for companies that have revenue first and foremost, but have reoccurring contracts, as in they've gotten people to sign up for their product initially, and those people have not only signed up again, but increased the size of their contract. We want to see that growth. We're typically looking, almost all investors are looking for low customer churn. We don't want to see a lot of your customers leaving after the first year. We want to see negative revenue churn, which means that the customers that stayed increase their contracts by more than the customers that you lost. That constant negative churn, so you're growing. We typically invest with other funds in the Midwest. We typically invest in Midwest companies, mostly because of valuation. We tend to find that the valuations here fit what we consider reasonable in terms of scale and size. We are really focused on the structure of the board. We want to know who's on your board. We want to know why they're on your board. We want to be in touch with all of your board members so that we understand how they view the growth of the company and the exit of the company, and does that match our view of where we need to be. We're looking for companies with multiple exit pathways. The first one coming in typically 3 to 4 years at typically a 4 to 5x valuation, and as a second exit option, typically 5 to 7 years down the road at more of a 7.5 to 10x valuation. That's who we are. We typically want a board observer position, although that's not required, just so that we can make sure that we're on top of it. We are hoping that you're asking for more than just money. One of our key terms is that we are more than capital. We want you coming to us because you find value in who we are and what we can bring to your company, more so than just the money that we're investing. We are extremely active. If you ask anyone here in CMU or mostly around Pittsburgh, you will find we are active, if not overly active, and we can be bothersome for those who are not looking for it. So that's our reputation, and we don't shy away from it. But that is who we are, and you should know this about that similar information about any investor that you're pitching to. I'll be around for a little bit for anyone else who has any questions off this, but thank you very much.